วัสดีค่ะ
สวัสดีครับ
Good afternoon, distinguished guests, respected faculty members, fellow organizers, and participants. On behalf of Chulalongkorn Business School, we, Chanida Pathanongwong, and
ปรัฐกรปรีชานกกูล
we would like to officially welcome you to the CBS International Symposium on Market Microstructure to 2025 and CBS X Allotment Market Simulation Challenge 2025.
This two-day event brings together some of the most talented students and aspiring finance professionals from both Thailand and abroad. Over the course of this experience, you will engage in research discussions, simulate trading scenarios, and build new connections that we hope will last beyond this competition. Let's begin this exciting journey together.
Alright, but before we start, let us go through the event's agenda. Participants, please be duly noted.
Today, we will be starting off with 3 research talks in the early afternoon for now until 1500. Then we will have a 15-minute recess with coffee break available downstairs. We will then return to this very room at 15:15 sharp for our panel discussions session hosted by Associate Professor Kanit Sangchot.
Our symposium event would officially end after the panel discussion session at 16:20. By then, non-competing participants will be asked for leaving. However, competing participants are required to stay, for there will be a briefing on rules and regulation for tomorrow's competition.
After the briefing, competing participants will be escorted to the financial laboratory to familiarize with facilities and have a system check.
We will end the day with a dinner and networking events exclusively for competing participants, the advisors, and professors at the Chayot Sombat 3 building.
And to mark the official opening of today's program, we would like to invite a representative from Chulalongkorn Business School to share a few words with us.
Please join us in welcoming Associate Professor Dr. Tartat Mokkhamakkul, Dean of Chulalongkorn Business School, to the stage.
Good afternoon. Assistant Professor Ratachai Silajalern, Head of the Finance Department, and all faculty members, and distinguished guests and students. I just talked to Professor Thanakorn that there are 23 teams from everywhere in Thailand and abroad. And I just start with welcome to Chulalongkorn Business School. Actually, I just heard that Lotman competitions is hosted by CBS, and this is the first time in Thailand and also in these regions. And actually, for the Lotman simulation competitions, has been started more than decades. And I think that actually for CBS, we believe on when we call the learn and learn, which actually when we learn and learn mean joyful, and we enjoy with the simulation game. And I believe that the competitions will be benefit for the students. You will learn and you will play with the simulations, and I think you can enjoy when you have the competitions. And I believe that today is the symposiums. You will gain a lot of knowledge. We have the distinguished guests to speak. We have the 3 sections of the research talk, and I think tomorrow, is the day of the competitions. And I believe that all of you will, have a good, memorable experience in CBS. And I hope that, for the competitions, will be very good for you and will be very beneficial for the students. And I hope that, tomorrow I will see, all of you enjoy the games, enjoy the simulations. And, I hope that these 2 days will be beneficial and memorable for you. And I will see you again tomorrow. Thank you.
Thank you very much, Professor Tartat. So may I invite Professor Tartat and all the speakers to the stage to take some photos with us. May I invite all the speakers? All right. Thank you, all this professor, for coming and joining on the stage. Let's keep this as a memory of the special event like this. Thank you very much. Can you please clap your hand for the event that very special and warmly welcome today? Thank you so much. Thank you very much. Oh, okay, all right. Can we just have like taking a photo together as a memory of all of us today? All right. Then can you all please just give us some smile? Thank you. That's so beautiful. Can you all please CBS hey? 3, 2, 1. CBS hey. Fantastic. Thank you. All right.
Now then, let's move on to the real event for today. Let's wait.
All right. With the competition now formally opened, we will now begin on our research symposium, a key highlight of today's agenda designed to provide insight into the academic and applied sides of finance.
To start us off, we are honored to welcome Professor Eric Kang, Academic Director of BMO Financial Group, Financial Research and Trading Lab from the University of Toronto. He'll be speaking on the topic Experiential Learning in Finance.
Thank you so much. Test, test. All right, very good. All right, just checking. All right, thanks everybody. Thank you so much for having me. My name is Eric Kang, and I'm the Academic Director of our Finance Lab, BMO Financial Group Finance Research and Trading Lab. And I'm also the Assistant Professor teaching stream in Finance at the Rotman School of Management. Before I start the talk today, just wanted to say thank you to everyone from CBS as well as to the participants for taking the opportunity to participate in this event. And it's really good for me to attend and then have this opportunity to also speak. So, and then looking forward to connecting with you later on. But my topic today would be about experiential learning in finance. And I'd like to share a few insights from the Rotman Finance Lab and my own experience, which kind of ties up really nicely to your dean's address in terms of why we're doing this. Okay, so in the next couple minutes, I will kind of talk into kind of that element. First thing that I wanted to ask was to see if anybody see something in common in these photos. Anybody? Got a firefighters on the top left. In the center, we have a looks like a surgeon, right? Some operation going on. We have a nuclear operation that's happening there. Pilots, doctors, astronauts. What do they have in common? Yes. High-stake professions. Do we agree? What's a high-stake profession? High risk and high return in a way, yes, right? High risk, right? High risk means what? If you make a mistake, what happens? Disaster. Something terrible happens, right? Something terrible could happen. If you're a surgeon, you make a mistake, you know, things could not go well. If you're a pilot, you make a mistake, you know, right? High-stake professions require, as a result, they require what? Very, very rigorous training, right? They need to be trained really, really well, and they need to be able to navigate all the types of situations that could happen in that profession. Firefighters, same thing. Astronauts, same thing. They're on their own, right? Dealing with the particular situation, but they have to be able to have the ability to navigate all types of situations. Do you agree with that? Okay. If that's the case, let's think about you, your profession. Eventually, you're going to graduate very soon, right? And then eventually, very soon, you're going to be a decision maker for your corporations. Some of you may be trading real life, market. Some may be making a decision for your corporations, right? For hundreds of employees, thousands, millions of employees. Are those high-stake professions? I think so, right? So then what do we need? Understanding the nature of high-stake professions, we also need, in this business school environment, to have a very extensive, rigorous training that allows us to navigate any sorts of situations that could happen to a lot of us in our profession. Do you agree with that? Right? And that is why you guys are here, right? We are doing this kind of a competition, but that's really is to understand the element of what we are exposed to and the types of simulations that we can go through and then be able to navigate those situations. Any of these professions, let's take a pilot. How do pilots get trained? They train through simulations, right? It's a bad idea if pilot trained by, taking off the actual plane full of people, right? Let's give it a shot. Let's hope for the best. Land safely. 100, 300 people, go for your first flight. We don't do that, right? They're in a flight simulator, and then we program these type of different scenarios onto the flight simulator, and then ask them to navigate that situation. How do you take off? How do you land? What if some situation happens on your flight? What do you have to do? What are the protocols, right? What are the expected events that could still happen, even if it has a very small likelihood of happening? So rigorous training is everything that we do at this high-stake jobs, and that's essentially what we do here tomorrow. The competition case that you've been doing was kind of simplified form of the real-life trading examples, and that is part of the vision that Professor Tom McCurdy had for our lab. So the professor who is also actively engaged with our lab, he's the founding director of this lab. He was the previous academic director. And just a little bit about our lab was that we have a similar lab space that Chulalongkorn Business School has, but we just started a little bit earlier. This vision is what Professor Tom had in terms of why do business school not have a lab, right? If you're going to produce a high-stake profession employees, right, where their decisions would have a very, very material impact, we probably need to train them better, just like medicine, just like pilot program, just like firefighters. So let's start that. So we started building this lab back in 1999. These are sort of the main goals that we had in mind. But we were the first kind of lab to, first business school to have a lab in that environment. And probably top 5 in Canada, in the world, back in 1999. That lab, the concept of lab was very popular in medicine or chemistry, life science, these areas, but not in a business school. Now, if you look at any business school, just like CBS, you will see a lab. And that's how much of the emphasis that you can see over time that's been put on the experiential learning. And that's kind of where things are at, and that's what we're doing today and tomorrow. A couple of goals that I had in mind was we want to enhance research, teaching and training, develop products for new teaching method and research, developing, supporting extracurricular activities, and then events locally and internationally, and that's part of the competition that we're doing tomorrow. And also present global opportunities for jobs for our students and for recruiting the top talents in the world. First topic on enhancing research, teaching, and training. We started off as an information portal. So what I would say about the lab is we had a lot of computers in our lab, and those just had information. So anyone looking for information could come down to the lab and search for information, just like how you look up on a web browser or library tools or any database. That was sort of how the lab has started early on. But then later on, that has changed to what's called the Dynamic Learning Center. So that would be defined as not only a center that provides information, but also the place that everybody, all the stakeholders could come in to learn about what's happening. So a lot of things that we've done is to kind of emphasize on the developing skills that's necessary for making good financial decisions given uncertainty and complex environment, and also provides practical practice for effective management of risks and opportunities across a broad range of business decisions. And we've ended up developing the software called the Rotman Interactive Trader, and that stands for RIT, so Rotman Interactive Trader. It's a market simulator. That's a software that we've developed in-house at the lab, and that is to essentially to get students to make a better decision in this ever-changing financial market. As you have been practicing over time, there's a lot of things going on. You have to be in the market, observe the market. You have a role that's defined, and you need to do something, right? And that's often a case that would be applied to you on your job. You have a role, you have a task, and now you have to do something. The idea is, how do I do something, right, that achieves the goal or the objective properly without making any mistakes? And if something unexpected happens, what do I go from there? So that's kind of how we've kind of positioned ourselves in terms of the software, and then to promote the simulation-based learning. The other mandate of developing and supporting extracurricular activities and events locally and globally. And these are the types of competitions that we've been running so far. Our premier kind of competition is called the Rotman International Training Competition. Chulalongkorn University has been actually, a business school has been sort of one of the many who's participated in that competition many, many years ago. And last year, I think they did a really good job this year too. But a very competitive nature. We have about 50 universities coming from all over the world that's competing. And also we have different series of competitions like Rotman European Trading Competition, Rotman Units Trading Competition that we had a chance to run in South Korea. We also run Rotman Market Simulation Challenge Series, just like this one, and then different types of extracurricular activities. This is our lab. You can see that that's our business school. We're located on the second floor. We have about 70 plus workstations, have 3 full-time staff members that we're managing. We have 20 part-time lab students, lab assistants, and we have access to the facility 24/7. So anybody who wants have the ability to come to the lab, use any of the terminals, and be able to learn how to make a decision and then train themselves. We run different courses. I teach a course in the lab too, but the whole idea of doing this is, again, to promote what's called the simulation-based learning. Part of the lab, what the lab does is this. So FRTL is the lab, so Financial Research and Training Lab. On average, every year, we have around 880 people, so that's the number of contacts that we have with the events that we do. We have all the way from high school competitions, market simulation challenges for pre-university students, and then open house, info session, orientations. We do this in our lab that basically allows us to have an initial contact with potential candidates to our business school programs. Our business school programs run from that spectrum, from full-time MBA, part-time, morning, evening MBA, Master of Financial Risk Management, Master of Finance, Rotman Commerce, Master of Management Analytics, Executive Program to Ph.D. This allows us to have a good quality contact point for potential candidates for our programs that we offer in the lab, in our school. We also are engaged with enhancing research. We have a lot of databases, a lot of real-time applications, data delivery portals, and custom applications. These allow us to, again, provide the type of resources that our students need and will use in their professions going forward. The moment they graduate, there's a high chance, there's a very good chance that they're gonna start using any of these tools that we offer in the lab. So the idea is bring that curve a little bit forward. We can start training them on these things early on. So that's kind of how we've positioned ourselves. Different types of data support, research tools, and the sort of the lab environment and software for research, which allows them to apply what they've learned in school to be able to apply it in the actual market and then get a meaningful outcome from that. During the actual school year, we have around 3,000 or so contacts. So our lab is a popular hub for classes, events, extracurricular activities. So it's becoming that kind of hub for a lot of students. And a dynamic learning center. These are sort of the pie chart of breakdowns of type of exposure that the lab has for different programs. But this number could change over time. But the idea is that the lab is in a centralized place where we want to be able to engage with different programs, different students from different programs. So we have all the way from bachelor programs to PhD level, and then we try to do something with those programs one way or another, all the way from teaching them what financial markets do and what that actually means, all the way to a PhD level where there's an extensive research using data. Some of the motivations for our custom product developments are the following three. So we use interactive simulation products to develop and practice decision-making skills. We design an RIT decision case, develop skills, and then try to promote some benefits of simulation-based learning. One of the key factors here is the following, where if you were to train, let's say, what we're doing tomorrow, so a trader. How would you say an experienced trader would look like? They have all the skills that they need, and then they've gone through all sorts of types of events that could happen in financial markets and their professions. That includes market crash, right? You would want your traders to have experienced that at least, right? So that they have the knowledge that they've gained from that experience. Anybody know how long on average it takes for market to crash or do some sort of a market correction? No. Anybody guess on average how long would it take? It takes about 10 years, okay? That's one cycle, okay, 10 years for the market to go through that boom and bust period and then crash every 10 years. So hypothetically speaking, that means in order to train or find a very experienced trader, you need at least 10 years of experience for that person to go through the entire cycle. 10 years is probably too long. We try to promote simulation-based learning, which is what you're doing, and we can have this happen a lot more in a safety net environment. Some of you had a wonder, right? If a trader had to go through this market crash, they probably lost a job because the markets crashed. They probably lost a lot of money, right? Whereas in the simulations for the competition tomorrow, I'm not saying you should lose money, but in case you happens to be losing money, that's okay. We're in this safety net environment where it is really to promote learning, right? And the idea is, again, we want you to be able to navigate all types of situations after you graduate when you make a really meaningful decision for your company, as a trader, or for a pension fund, whatever you're working on. We need you to be trained better. And that is by applying what we've learned in class and courses and then to the real life examples and the scenarios. Okay, so that's kind of reiterating the point about that. So these are the two software we developed. We have one called Portfolio Manager. The other is the Interactive Trader. And that's the software that we're using for tomorrow. Some of you have been using this for the past 3 weeks or so for practice. And that's essentially what we're doing. We have different types of cases for tomorrow. I'm going to kind of talk about the cases that we're doing tomorrow just so we're on the same page. But very interesting software. We have about 50 plus universities using this software. Includes Stanford, Chicago, MIT, all the way. So we do have the sort of number one market share in that field. And that, again, says a lot about how rigorous universities, how top universities kind of agree with that idea of being able to train our students better and using simulation-based learning opportunities. A little bit about where things are at with the scene in terms of the competition. We run Rotman International Trading Competition there. We also run Rotman European Trading Competition. That's actually already scheduled for next year. We've run in South Korea Rotman Unis Trading Competition. And there are a few other things that's in series that's in planning. But again, the idea is to be able to promote this simulation-based learning and through the experiential learning in finance. And that's kind of where things are at with that competition. These are the list of schools that we have either exposed to or have used our software or are currently using our software or participating in our competition. We have about 76 universities in Canada that's using our software, which is pretty much everybody in Canada. US, these are the list of schools, as you can see, all the way down to 75 different schools in Europe, all the way from Albania to Malta. We have Italy, that's part of, so yeah. One of the Italian universities hosting the European training competition. The list goes further. In Asia, we have the following universities that has used our platform and participating. Unfortunately, we only have Chulalongkorn, but down the road, we'll have more, and that'll be an opportunity. But again, that's kind of what we have, and 8 more universities in the other region, which is probably another opportunity for us to promote this simulation-based learning. What I wanted to highlight also was that student learning isn't on its own. After that's done, we promote that to our global partners. So as a university, we have partnerships with these companies, some of the names that you may recognize. One of the hedge funds in the world are using our software. One of the global oil traders are using the very same software that you're using to train their own traders and decision makers. So it's not just for students, but really for anyone who needs to be a better decision maker who can make an informed decision down the road. And that's where we also try to promote in terms of recruitment opportunities and then partnership opportunities for our students. So these are some of the sponsors for our competitions, and that's essentially kind of the opportunity that's available to our students as well. Once school's done, our activity is not over. We also have this lifelong learning opportunity. I think CBS is also promoting that. I saw some of the banners outside, which is to have different types of alumni events, including competitions, edu-social events, executive programs, mentorship, sponsorship, judges. That's what we promote after our students are done and be graduating from our school. On average, we have about 380 contact points for this type of events. And that is also to say that learning never ends. Lifelong learning is kind of where it's at in terms of what we promote. And that's kind of the area that we want to position ourselves better in terms of being able to have access to really good talents from high school all the way to PhD level and then beyond. That's kind of our goal, and then where the lab plays in terms of the learning opportunities. Any questions so far about kind of our lab and what we've been doing so far? Okay. I had a chance to speak to, yes, go ahead.
To know how the difference, or it's better than use the real price data from the market. Better than, so why we use simulation price, and why don't we use the real price in the market instead? Thank you.
Thank you for your question. So the question was, why are we not using the actual data from the real market? Why are we using the random walk or martingale process to drive the price point for the simulation? Great question. I guess that depends a little bit on which price data that we're going to look at. That is to say, the simulation has the ability to import the actual prices and run through the simulation. However, I guess the researchers will agree that price is just one draw from defined distribution. So even the distributions that you're seeing in the simulation would actually be driven from a lot of data points, and we create a distribution based on certain model, and that is to replicate the potential draws from that distribution. Right? If you look at how the price evolves, it's that one draw from a distribution. So the idea with that is if you have the ability to run the simulation using different draws from the very same defined distribution, we'll have the opportunity to experience all. Right, so that's the angle to it. Great question.
Good, thank you.
Thank you. Any other questions? Okay. So just checking time to make sure that I have time, right? Okay. All right. I had a chance to speak to Professor Tanakorn about having these two cases summary. So the idea with these two cases that these are the cases that you will be trading tomorrow and that you've been practicing. I know that some of you didn't have a chance to kind of review or practice too much, and some of you had questions about the nature of the cases as per the other students. So I thought that it might be a good idea to give you a rundown on what these cases are and what they're about, so that at least, you know, before you do the competition tomorrow and after, you will know that it wasn't just a game or a simulation, but actually have a real implications to what we do in real markets. So the first two cases, the liquidity risk case and the ETF trading cases, are really related to the topic of managing liquidity risk as a liability trader. So your role in these cases are a liability trader, and the idea is that there would be institutions in the market that's willing to trade with you. So you can think of these institutions as a mutual fund companies, insurance companies, or large pension funds that have large positions, and they don't necessarily want to trade in the market themselves, so they would trade with you as who are the liability traders. And those are basically the tender offers you saw in the software. You had a large positions that was presented to you at a price that's probably very attractive to you, right? If they were to sell to you, they would sell to you at a discount, right? Or if they were to buy from you, they would usually be offering a premium price than the market. So if you look at the position and the price, you may be thinking these look pretty nice, right? They're a good trade. The market's trading at $10. I'm being offered $9.50 to buy it. It's probably good. However, what you're seeing is that they are selling the risk to you at that discount, right? Now you take on that role as a liability trader and having to manage that position risk. You now have to unload a large position, right, at a profit, and the institution is willing to do that with you because they want to sell that risk to you. So these premiums or discounts that's available to you are the value of the risk. Now, as somebody then who is assessing that, we'll have a few structure to think about. How attractive is that tender offer? Is it good or is it bad? If you want to go one step further, is that spread large enough for me to justify my action, right? Can I take up on that spread of 20 cents, 30 cents? And then could I capitalize on that position, right? Based on what I see in the market. What's the liquidity looking like in the market on the buy side, bid side, ask side? And how good am I in terms of the order flow? Submitting limit orders, market orders, or different types of order flows that I'm gonna manage. In the end, can I execute all that trade and still end up with the profit? Would be your first assessment. Once you do that, and in your mind, if it's a good idea to accept it, you should accept it. On average, I think there's 10 tender offers you're gonna get in 10-minute time period. And then now you have to execute that trade, right? And you could accept a very profitable, perfectly fine tender offers, but still end up with the loss. And that's okay, because that is essentially your execution risk. That's a market risk, right? Take on a position, market just moved against you. So maybe you have to cut a loss. That's okay. But these are the elements that we're gonna expose to when you trade as a liability trader. That's primarily the case for the first one that you're trading. Second case makes it a little bit more interesting now that we have the ETF, right? So you can have the ability to trade the ETF on its own or through the assets by creating or redeeming to an ETF, right? So that makes that a little bit more interesting. The other institutional features that we have is also called front running. So that also means if you trade before you accept a tender offer, because you know there is an offer already to you, anything that you do with that would be penalized. Because legally and by the regulatory framework, I guess our next speaker could speak to this a little bit more later on, is that you're not allowed to front run any types of the client's orders that's in present. So those are some of the realistic institutional features that we have for the simulation. Yet they're kind of simplified for us to get a better sense of what it feels like to be able to work as a liability trader to manage a liquidity and market risk. Okay, so that's sort of the summary for case 1 and 2. Case 3, which is where a lot of you guys had fun with, is the trading market inefficiency using transportation arbitrage. So In this case, your role is a statistical arbitrage trader. And that concept is pretty simple, right? Because we observe market inefficiency in this market because the very same crude oil is trading in 3 different locations, and they all have 3 different prices. So the idea is, if I have the ability to buy the same crude oil at a cheaper price in one market, pay for it, pay for the storage, pay for the pipeline where you have to move to another location, and then store it there, and then sell it in that market, could I still make a profitable trade? So that's the conceptual understanding, which is relatively simple, right? So considering all transaction costs that's related to that trade, is there a profit opportunity? And that's what we're gonna observe. And if yes, then we take on that trade and then check the market inefficiency where you want to make that trade. However, it's not entirely a pure arbitrage trade here because there's a risk. Risk being, the moment you bought those crude oil underlying spot assets, store them and move to a pipeline, it'll take some time. During that time, price could change, right? It could change in your favor, but against your favor, right? Could just move away from you. You bought it at $10, but by the time you move to another location, now it's $7. You're gonna lose money, right? So how do I assess that much of risk? Is that the risk that I'm willing to take? And if you're to observe this market, there's a sense of how long of an arbitrage, right? How long that usually lasts, and at what kind of spread I'm gonna get on that arbitrage opportunity. So it is something that it's very important for you to observe in the market. So observe the market inefficiency first. Have some sort of a statistical understanding of, very simple, how long it lasts and how much of a spread you're gonna get. And that'll help you make an informed decision as to what type of opportunity you're gonna find and when to make that trade. Okay, so those are some of the elements that I'd like to mention. And we see these market inefficiency or arbitrage all the time in the market, right? I guess in Thai market, there's futures on commodities or agricultural products. So you will see that in the actual market where there's derivative, like futures products, and the underlying asset, there's a price to wedge that may justify the risk exposure. Sometimes that wedge may change, and that may they may open up opportunities for anyone to trade on that. So these are some of the elements that's already embedded into your simulation cases tomorrow. And hopefully this kind of overview gave you an idea of why we're doing and what we're gonna do today and tomorrow. Okay, all right, that's it in terms of the presentation. Thank you so much for your participation and attendance, and I'm sure we'll have more time to connect in the afternoon in terms of networking, so happy to take on any questions then. Okay, thank you so much and welcome. Thanks.
Thank you, Professor Kang, for the session. I'm sure we all have know more about the importance of trading simulation, much more. We now turn our focus to local research about set microstructure.
Please join us in welcoming Assistant Professor Wasin Siwasarit from Chulalongkorn Business School, who will present on set microstructure data titled New Set Market Microstructure Data, an emerging research topic for deeper understanding into Thailand's capital market. Please join me in welcoming.
All right. Thank you, everyone. I'm very appreciated to be here, and I will spend around 30 minutes to take a short tour for the new research opportunities that the Thai researcher and especially the academia field can do in the next few months. So let's get insight to the set market microstructure. What does it mean by this? Before I start, so everyone in this room, I think when we took the class Econ 101, so now the lecturer in that class then inform you about the good thing in our societies in form of the markets. And we call those kind of the ideal markets as the competitive markets. And when we are talking about the competitive market, everything is look good, right? So there is no frictions. Everyone can have free trade, and we are the price taker, and we don't have the asymmetric informations. The same way, the day that if we look in the case of the set market microstructure as the markets, and then from the supply side, we are the researcher who wants to use this data to publish the paper. There are so many friction in there. So now they have to take a time to do, they incur the learning cost to learning something new, especially at the first stage when we want to key in the data. And that's why we initiate these projects date back around 2 years ago, because we want to minimize the gap between the researcher who want to use this data in their research paper. Okay, and before we start, I think I like the way that Eric showed us the picture at the beginning of your session, right? So here is the same. We do have the big team, and I think in this room we do have Ajahn Pantisa here as well. So she is the head of this project, and we collaborate with so many friends from Thammasat University, Bin Chao, and Ajahn Juthamat. We do all the thing all together to create the platform, and we create the learning resources that allow the people right now to use and to understand deeply about the market microstructure in Thai case. Okay, and here is the beginning things. When we are talking about the concept of the market microstructure, I think that back several decades ago, the paper by the Garments, he is the guy who mentioned this term first time. And along with the paper by Esley and O'Hara, the big name in this field, in the year of 1995. So they describe this field as the study of the process and the outcomes of exchanging assets under explicit trading rules. Okay, and as you can see, it's related to economic sense. It's related to the microeconomic sense in terms of the market structure, the regulatories that we impose to the markets, along the way of the agent who participate in the markets with the different time frames. And that's why if you kind of to use the real data to study, and as Eric mentioned, so we do have more than a decade of the data for the market microstructure in Thailand. That means you can study from the peak time up until the lowest time in the business cycle in your study research. All right, and another one, I think that if you search the Google, there could be a group of the people who have the same common interest in doing the research paper with the market microstructure, and they set the group in the NBER. And if you go there, they're gonna define the market microstructure as the field of the study that beside from the asset pricing, that beside from the corporate finance, there could be another fields that devotes to study theoretical, empirical, and as well as the empirical experiments research on the economics of security markets. When you use this market microstructure in your work, you can set so many questions as you want. For example, you can look at the structure of the market that had changed over the time period, and you see how the market react to that structural form that we have. You can look at the price formations and the way that the market react when they exposed to the negative shock or positive shock. As well as you can look at the transaction that may occur in the market sometimes, and the timing cost information, and also the behaviors of the different group of the participants in the market. Okay, and that's why we kind of to keen to create this project to allow the researcher, especially the graduate student, to do the research in terms of the market microstructure. And thanks to the CMRI and as well as the CMDF who support us with the funding and also the data set for doing this research project. Okay, so nowadays, if you are affiliated with this 10 university, you can get access to the data. You may have the key person that you may ask to contact with and get access to the raw data, and including Chulalongkorn University as well. Okay, but however, what we have observed so far, even the Stock Exchange of Thailand provide us the raw data that back 10 decades ago, we still have the usage remain limited. Why? Because it's pretty hard to use this data set, especially the way that we clean the data and manage the high frequency data in the effective way. You need to learn some skill such as using the syntax in SAS or even in the Python to clean this data set. Okay, and that's why in this project, our goal, I think, we want to create the good environment for all the researchers in Thailand to have a ready-to-use database that allow us to do and focus on the main research question directly without losing the time that they need to spend on cleansing the data. Okay, and that's why we have this project. And if you look at the project here, we actually have the three main objectives, which are we want to promote the research productivity in the market microstructure from now on. And the second one, for those of you who never know the research idea in the market microstructure, so we develop the e-learning modules that allow you to understand the key concept in the market microstructure, the way to clean the data by yourself using the SAS program, and as well as we want to minimize the loss and the data privacy that you may have when using this data market microstructure with Stock Exchange of Thailand. Okay, so now I think it's time for us to look at the data. Okay, and you may think about the research topic right now. So what you want to do with this data set? So first of all, look at the raw data first. All right. So now I think the university who have the agreement with the Stock Exchange of Thailand, actually you can get access to these two files, which are the due files that contain the match order already, and also the other files that represent the timestamp limit order book. With these two files, so now the data, they contain in 1 month of the data. Why? Because the data storage is so big. For example, if you use the due file per 1 month, it takes around 2 or 3 gigabytes to store this data set. That means if you want to study the financial cycle or business cycle, it takes a ton of the gigabyte to clean this data set by yourself. Okay, and from this data set, they are classified as the buy side and the sell side, but unfortunately, you cannot track the trader ID. Okay, so now the identities of the individual trader are not disclosed in this data set, but then you can separate the trader type into 3 different groups. In Thai case, we have the foreign, retail, and the local institution, which is include the proprietary trading as well in this group. Okay, and with the raw data set, when you open it, using SAS, for example, there could be 22 different fields for you to fill in by yourself. And that's why there is no doubt if you search the Google and search the database about the IS that conducted by the graduate student in Thai case, it's likely to find out the paper they're going to use the market microstructure in their work, because they have the time constraint to graduate the program. For example, a semester or 2 semesters. So if you want to clean the data by yourself, it takes a semester to be done all the data that they want to study, right? And that's why we are here to be the market maker. So we want to fill in this gap. Okay, so here is the example of the DIL file in the data dictionary. So if you look at the data, they have a lot of the definition that you need to clean by yourself. For example, if you look at the case of the short fact in the variable 16, we have the 3 cases in the raw data: the normal, the short sale, and the special short sale. And we have the 2 main markets to trade, the main board and the MAI board as well. Okay. And now here is an example of the other files. So there are a lot of work to do if you start doing this by yourself. And here is the example of the data format when we open this by using the SAS program. So then if you look at the data, for example, the variable 6, it is the timestamp. Okay, so now the format of the timestamp, they can be hours, minutes, second, and milliseconds. Okay, so now by using this timestamp, so now they can explore and set so many research questions in the market microstructure. If I summarize the data advantage for the researcher, so then you can identify the trader type in your research paper by buy or sell type, or even by the market segmentation, local investor, foreigner, or the local institutes in your research analysis. We do have the short sale facts and other type as well, the market or the limits order. Okay, so now if you want to set the question relates to these 2 type of the execution, we have the non-voting depository receive, and it starts after June 2001 as well in the data set. But we still do have the data constraint, which are the privacy compliance. Okay, so now that means you cannot be able to track or trace as a time series for the trader ID. You only know about the big 3 groups. And it's pretty hard to clean the data, as I mentioned, because it's pretty big. And you need to learn how to use SAS to filter the data and clean the data, okay? But thanks to CMRI and CMDF, they allow us to have this opportunity to clean the data for the Thai user, okay? So now here is the thing that I want to sell from here. So this is the real data set, okay? So now you can do so many things. I can remember the day that I conduct the research paper with the graduate student several years ago. We do the algo trader comparing between 2 markets, the Thai case and Kospi case in the South Korea. And now we use the intraday data. At that time, we take several months to clean the data by ourselves to see the style effect in the market. But nowadays, it's very easy. So here is the chart that visualize you guys how to use this data from now on, okay? We have the inputs from the left-hand side. We cover just only the set 100s, Okay, for the main reason because if we cover all the stock in the Thai stock market, so I will retire pretty soon before I deliver the job to the CMI. so I have the raw data, the limit order book snapshot, and the frequency of the data, they're going to be tick by tick database นะครับ so the processing step we conduct from you right now, we aggregate it in 30 minutes windows. Okay, so some of my friends ask me, so if I want to do it to be just like higher than 30 minutes, can we do it by yourself? Yes, you can, because I provide you all the steps that we clean the data. You just change a little bit in the syntax by yourself, and you can change it to be 1 minute, 5 minutes, and whatever you want in terms of the intraday window. Okay, and now we have some statistics for you, mean, median. I myself, I love this kind of thing a lot because when I took the class with Tim Borislev at Duke University, so we learned about the time series data, and I know this is a very valuable thing for conducting the volatility models. So when you conduct the volatility model, I want to get this kind of the thing to help me to get a better understanding the pattern of volatilities over the time. And now I want to quantify and get the higher accuracy rate in my work. And here is the point. Now it's available for you at the fingertip. So now you can use it by your hand. So we have classification by the investor type. For the order file, we split the data by using the concept of the quintile. Okay, for example, within 30 minutes, we rank the price from the lowest one to be the highest one. And now we shop it in 5 boxes. And now we use this to be the ask price 1, ask price 2, and ask price up until ask price 5. That's going to be the 5 bid ask price level that you can further investigate more in terms of the bid ask spread, or even you can compute the ratio such as amihud, illiquid ratio, and now you can fit this into your work directly. Okay, so now that's going to be the usefulness of this feature. So at the end of the day, then you have so many things for you to explore. I think this year we should have at least 10 publications, right, with this kind of the data set. So we have the key feature. We have the return intraday. We have spread, volume, the depth, order book liquidity measure. And we deliver this to the Stock Exchange of Thailand. And now they're going to put this along with the raw data for you to use. Okay. And here is the trading sessions that we define in this research project. So if you look at the time interval, so we have the number start from 0 up until 11 before the market open in the morning session up until at the end of the day. Okay, and as you notice, we changed this system since June 2022. So now we shorten the lunch break, right? So now if you look at this one, the lunch break starts from 12:30 up until 2:30 p.m. But right now we shorten 30 minutes. Okay, so now you can just like change a little bit the code by yourself. If you want to study what happens after we change these trading rules in the markets microstructures. Okay, and here is the product we have. Okay, so for the deal file, we have X different files that are available for you to use. Okay, the deal price, for example, if I am the econometrician, so I would love to use the deal file. I use the mean and the median price to conduct volatility model and conduct the complicated models such as the mixed frequency data based on this data set. We also have the VWAP and the deal value volumes, the buy side, sell side, so many things that allow you to use. Okay. For the order file as well, so we conduct the order from the buy side along with the sell side, and now in terms of the price and volumes. Okay. So up until this page, if you have pop up the question in your mind, right? So now, what kind of the research question that you can do with this data set? I think we can use this data to do several areas in the market microstructure. For example, we can use it to analyze the intraday event study. We can conduct a better model for forecasting volatilities. We can investigate the response from the different group of the investor in the market when they exposed to the shock in some events. We can look at the effectiveness of the order execution analysis. We can study the market microstructure that relates to the liquidities and the transaction cost. That's the thing we have, all right? All right. Along with the data, we also write down the handbook as well. So right now we do have 2 handbooks. The first one, we call it as the Stock Exchange of Thailand Intraday Handbook, written by Ajahn Pandisa and Ajahn Bin Chao. So in this handbook, if you are very new to the market microstructure, you want to clean the data by yourself. At the same time, you want to learn how to code the SAS programming. Here is the best place to study. And if you don't want to read it by yourself, we do have the YouTube as well to teach you step by step how to do it. So at least there could be just like the e-learning resource that you can just practice by yourself how to code in the SAS programming. And another book, I just wrote this book with Ajahn Pandisa. So now we just write it in Thai language because I think that's the majority of the researcher. We are Thai. So now that's why we just write down this book in Thai. So now in this case, we're gonna kind of to describe what does it mean by the concept of the market microstructure, and as well as how can we measure the liquidity by using the market microstructure variable. And then in the chapter number 3 and 4, I describe the way we apply the raw data, the data set that we have to the work that relates to volatility model, as well as we can visualize this data by using the Python. And that's going to be the concept idea of this handbook. Here is the some of the example of the result we have. So after we cleansing the data, it looks nicer, right? So now I import this thing into the Python programming. So now you're gonna have the timestamp, you have the ticker, you do have the time interval, we have the price and all the thing we have. And now you can just write down the code just like a little bit more that relates to your work. For example, I transform this to be the log return, and now comparing between using the median price and the VWAP. And now you can plot the graph and comparing with the trading volumes, and also you can feed this to conduct volatility model in your works. Okay, here is the example. For example, if you want to use the same concept idea as in this paper, exploiting the error, a simple approach for improved volatility forecasting. So now you need to have the RV, the realized volatilities, and now you can feed the RV into the standard volatility models, and now you compare your result with the conventional one, such as the GASH or the old school model, and that's going to be one of the applications that you can have a better understanding in terms of volatility forecasting. Along the way, I think I love the way that you link this kind of the concept with the macroeconomics, and we call the field as the macrofinance model. So right now, they still have so much room for the researcher to have a deep understanding how the macroeconomic variable, they're going to react into the market microstructures. Okay, so now there are a lot of the questions that are waiting for us to explore and answer this in the Thai case. Okay, and here is the example for one stock. I pick up the K-Bank, and now I do the data visualization. So now you can have a better understanding what's going on in terms of the particular stock in Thai case during the time period that you want to show your student. You can just look at the day at the beginning of the day of the years up until at the end of the years, and as well as along the time period that we trade. Okay, and that's gonna be one application that you can use. And now I kind of to have a simple way to look at the relationship. Here I merge all the data in July 2018, and now I look at the average price over the time interval. So now what we can clearly see from this picture, we still have the smile shape in the way of the pricing and the average volume as well. And from the data, if we split it into the trader type, so now I just like snapshots the day before we have the circuit break in Thai case, and at the day that we have the circuit breaker. What you can see so far, the local investor, we have the net buy in terms of the total value in the stock market, whereas the local institute and the foreigner, they're going to be the net sale. And this allows us to have an understanding the rule that we use when we apply the circuit breaker. For example, compare this situation and date back at the time we do the circuit break in the 2008 to see whether we have the same pattern or the different patterns. So now that's going to be the usefulness of this data set that allow us to understand the inefficiency in the market in several approach. Okay, here is the example of the markets that you can use to be the reference circuit breaker and the market runs. Okay, and here is another one for the other files. Okay, so as you can see, when we combine the data all together, we're gonna have the bid price and the ask price ranking for 5 bins, right? So let's start from the level 1, the highest price from the demand side. And if you look at the supply side, so then you're gonna have the lowest one at the first bins as well. By using this data set, you can conduct and see how the buyer side and the seller side, they're gonna react to each other in the certain events. For example, in the normal time, as you can see, the buy side and the sell side, we have the same kind of relatively comparable between the liquidity in the buy side and the sell side. But once we have the bad issue in the market, for example, we have the circuit break. As you can see, we have a lot of the liquidity from the sell side, but for the buy side, so now we have a certain limit order that sends to the market. So now that's going to be the clear picture, the data we have so far. Okay, so now one more application by using this data set is allow us to have a deep understanding in terms of liquidity in the markets in several approaches. Okay, so now you can even use this is a very famous paper by Amihud, right, in the Journal of Financial Market. You can calculate the illiquid ratio and can use this to have a deep understanding how the market interact with some market events. Okay, all right, so now I think it's almost 30 minutes. So last but not least, okay, you may have the questions about this data set, right? So here is the frequently asked questions. Who can access to this data set? The answer is all the faculties and students of the school who have signed MOU with the research department of SET or CMRI, okay? That's a good thing though, right? So now I see you have a screenshot, right? So please feel free to take this, okay? Because that's gonna be our goal. So we want all the students to use this data set, how to access to this data. So now you need to compete fill in the data request form. You may ask the key contact person at your department or from your school how to get this data set, okay? And now they're going to be the key person from the Stock Exchange of Thailand, P. Butsaba, P. Sumita, and all the team from the research department of SET that you can contact to have get more information about this project, okay? How long does it take after you send the requirements, the request form? Approximately from the past, it take around 1 up until 2 weeks, up until you get approved to get access to this data, okay นะครับ and that's all for my session ครับ thanks you all ครับผม
Thank you, Professor Wasin, for providing such a deep dive into insightful information for the market microstructure. All right, next session is going to be
Building on that strong foundation, it's about the landscape of modern trading strategies by Kun Vithan Minaphinant, Investic founders ครับผม
Please welcome Mr. Vithan Minaphinant ค่ะ
All right, first I have to thank you to the CBS and Rodman to host this event because back there like almost 12 or 13 years ago, I was a student in Chulalongkorn and quite similar to this audience here, those guys who attend the competition. And I have to thank Assistant Professor Wasit for the database project. It's very promising, very nice because after I finished the graduate program, right, I go to work in the bank. But before that, I don't have any data. You know, it's very hard for students to get that level of data. So thank you very much. And all the students here will thanks to you later on. All right, so let's begin. This session would be about what's very happening in the market. And what are those hedge funds and also the banks, say asset management company, and also the brokers, what are they doing? And also for the algorithmic trading, that's the strategy that they use. All right, so a bit about me. I was like, say, a market practitioner, right? So I was in the Kasikorn Bank, working as a quantitative strategist on the multi-assets. And then I quit and I co-founded Phenomena as a robo-advisor. And then I quit again and start my own company. It's about the lab, about research on strategies and algorithm, something like that. All right. Sorry. Okay, so today, let's dive into a few things about say we got only 40 minutes session, right? So it will be a brief idea on what's going on in the market and say some tips and tricks from me. Because actually I did a lot of algos already and finally I decided to settle in directional bot, right? But I can teach you about non-directional too. And also the algos that is needed in the banking. All right, so let's start with summarize the big picture on algos type first. I think it's easier to point. Yeah. So basically, most people would jump into this field with interest in the first one, the alpha seeking one. But in reality, that we work in the bank mostly is on the market making and also the risk management things, like the case 1, case 2 is all about how you execute. You buy at a discount, but when you have to sell, you need to calculate the liquidity first. And the other type, if you do like the TWAP, which is time-based, it is fine. You need to do the back test first, right? You need to study about those first. But in those who are best at this, they will mix the alpha seeking strategy into it too. Say those who are hedge funds and those who are dealers, right? And you notice the blue words here, like when it talk about the mean reversal. Yeah, there is some part of market making too. Also, same goes for the arbitrage. There's some part of market making too. It goes together. I would say that. Oop. Sorry, again. All right. So first, let's see. In the what are they doing, right? For the hedge funds, surely they do the alpha-seeking strategies. They want to make a profit. But some of them are working as the executioner too. Like you heard sometimes that Bloomberg stopped working and suddenly price jumped like 5%. And those are what hedge funds do too. And the investment banks, mostly they are investment bank and asset managers, they're working together. Investment banks are more like executioner, right? So they do the hedging, execution, and also provide liquidity. It's like market making. For the asset managers, it's more on the long term. Even though you have funds, most of the funds right now are long term. Those high frequency trading funds belong to hedge fund. For the asset manager, the easiest example is Ray Dalio one. The risk parity portfolio is more on long-term basis. And for the retails, most do more simple rules like grid trading and some sort of that, which is quite similar to mean reversion strategies. Okay, so I would say that each bank has their roles, right? Same as the algorithm. Algorithms are grouped into roles, and so that it goes as its names. Like the alpha seeking is for making profits, both directional and non-directional. But what interests me is the liquidity part. Those who do the market making can also make, say, substantial profits. Say you can earn like 10% up to 20% per year with the market making model too. Also the risk department, when you do the gamma hedging, if you go to the bank and say you work as a derivative traders in the banks, their job is to do the gamma hedging. And the nature of the products in Thailand, say most of structured product that sell to clients is this short gamma. And when it's short gamma, it means if you do the gamma hedge, you will earn profits. So it can be a alpha-seeking strategy too, right? So my friend who work in that field will discuss what should we do to earn the most, because if we hedge more, we earn more, right? Okay. So today I will have a few examples for you guys. First one is on the mean reversion, which is the most popular. Say because it's the most popular because it's also not only the alpha seeking, but it's also for the market making too. And for the retailers, most go to this one, trend following, and also the asset managers. The mean reversion strategy is all based, their root is based on this chart. It's about the return distribution over the time, right? On the y-axis, it represents how much it happens, how many times it happened. It moves like 10%, it moves like 2%, how many times? Say this chart is on the daily return. So these blue columns represent the probability of stock price moving per 1 day. Say most of the time is here, right? Around 0, most of the time. And it's very few times that is moved above 3% for this chart. I think this is gold, I guess. Yeah, it's gold. Say what we are looking here, we can just flip it over, right? Rotating 90 degrees and put it on the chart. Here's on the gold price. You see that this is the range for 1 day, right? Around here to here. And you see the price movement is still within this range. It's quite hard to see, but it's here. But some people will convert this into more advanced calculation like the average true range, which because this one is based, it is based on what? It's based on end of the day return. But actually in the day, like price may swing high and low, right? So the real volatility should cover all of those, both low and high too. So people come with a new idea. Is this ATR, average true range? This one is 1 day ATR, this range. This is 2 and 3. And it's quite similar to the standard deviation. So this basics is, I think this is very fundamental for mean reversion strategies, and it's the same for the market making. So for the tradings, it will look something like this. This is very popular strategies. For the market making, all you need to do is you lower the band, right? You lower the band, and it will look something like this. Sorry, here. Say if you lower the band with the equal distribution, say you put same like 500 bahts each per one tick in the bid and also in the offer, it will look something like this. Say, I'm not very sure I could tell, say the case question like from my experience like 10 years ago. Is it safe? Okay. 12 years ago, the first case is market making. So that's why I teach market making today, right? So I believe the winner, this strategy, they put the most in the middle. They put the most in the middle. On the first case, I got like the first runner-up. I do this strategy, so I lose because most of the time, the price is moving around zero, right? So you need to adjust your strategy to for the question. I mean, like you need to analyze them first. But these are really popular 3 strategies that they will do. First one is we focus on the spot price. Say if the stock trade at 100, we put like 97, 98, 99. Around that, and the rest is just a little. And then we move it. We say when price move like really fast, like in 2 seconds, it's wipe out all the bid. It's moved here. So we lost less, right? We lost less because we were buying here. We lost less. Then we just put it again. But if we do the bid-ask strategy like this, say you may have like 1,000 bahts at the first tick, and say 10,000 at the 5 tick. You lost less when the price moves so fast. This one will be benefits when the liquidity is not enough here. So the easiest way when you might heard about the liquidity, those things, say to understand it's very easy is that if you hold it and you want to sell, can you sell it? Right, that's the easiest way to understand the liquidity. So the market maker will come and fill in this bid offer. That's their job. I would say that on the left, that would be the typical one, normal one. But this one is like you need market maker. So let's go back a bit. But the point when you do the market making or you do the mean reversion strategy is there's sometimes this chart first. This chart is represent the hourly movement of the gold price. Same for the stocks, like for the set index, set 50 futures. Same for any individual stock. It always moves within the small range first, within 1 SD. And then sometimes it's moved say you can say it's a short-term black swan. It's moved like 5%, 10%, more than 3 SD, like here. And if you do the robot trading and or perhaps you're a market maker, you suddenly get a 5% loss from single position. How will you manage it? That's what you need to think about the money management. But if you run the alpha seeking bot, I say this is the most critical problem, classic problem for them, for the retails, and most of retails fails on this because their algos will lose all money because this. Well, so if you choose your strategy wisely, you will suffer less from those big jump, big move here. So most of the people that do this strategy, they will choose this one as a safe bet, say it's more safe structure. Because when price move, let me show you here. It's moved like one in single hour. It's moved down like 4%, and then next it will pull back. See here, and if you look at here, if your model is dynamic enough, that one is not dynamic. This one is not dynamic. But if you put your model to be dynamic, you will lose, the chance that you will lose a lot of money is less because it is dynamic. Say, you can imagine this is as a one day candlestick, or you can imagine this as a one tick. It's up to you. But it is literally the same. Okay. All right. So apart from that, I would love to have another example on the directional base. Well, in terms of directionality wise, what do you think about the mean reversion strategy? Is it really no direction, or it has direction? We can answer this. Is it really no direction? It still have, I still consider it as directional bet. It's not really non-directional. Well, because it's really obvious that if the market is going down, right? Say it's going down this way, then you take long position. So in that sense, you have long direction. It's not market neutral strategy. It's still a directional bet strategy. With you wait a bit until it's recovered and you sell. It's something like that. So that one is counted as directional bet too. And I want to give you another two examples of the strategies. First one is the trend following, and the second one is the arbitrage, right? So the arbitrage is the, say, only field strategy that is real non-directional. It's a market neutral strategy. Even though you have a long short strategy on the macro level, right? That one you can do it wrong, and because the correlation will change a bit from time to time, and you need to adjust your model to really be a market neutral strategy. So most of the strategy are directional. Say this one is the most typical one of the trend following model. And if you go to talk with the bank people, or you go talk with the hedge fund people, those people rarely do this. They rarely do this because it's noted down here. Because most of the time, the assets stay idle. It goes sideways. And whenever it starts to look like this is a trend or not, there will be a bot hunter that will spark the false signal, and then they kill it. That happens at the night. Every night, there are bot killers. So most of the strategy, most of the funds, they don't really do this. Most are retail traders. And but the beautiful of this thing is that you can study and backtest them. And I want to show you this, but I will start with this first. So when you do algo, the benefits of doing the algo trading is that you can go through this process as many times as you want. You start with the data collection and you develop your model. And then you go back test. And you can do the forward testing and adjust things. But I would say that this is from my experience. Here is like a, say, all the beginners will go through this. First one, when they do the data collection, most of the bots in Thailand, the algos in Thailand that fail, most have this problem. When they do it, they do on the uptrend. Say they set trading volume per day is like, say 7,000, but nowadays less than 30,000, right? So now there is not enough liquidity. When I work with bank, when a bank come to me and they will give me a mandate, and their mandate is very simple. The fund should accept, say the AUM would be around 1,000, and they will have one constraint, the liquidity. Like the fund have to liquidate the position within 3 days, something like that, and they will say that the stocks that pass the universe, their average trading volume would be more than, say, 300 million baht, something like that. The first problem is the liquidity. Second is on the model development. Most people overfit it because they pick very short period. And most of the models that are out there and say they are too underfit. It still do their jobs. The owner of the bot will earn money. They will probably earn like 5%, but you know, for the long term, say you just buy and hold stocks, your expected return is 10%. So it's when you do the underfit model, is inferior model. So my tips for me and also my friend, those who run successful bot, we do overfit bot with switcher. We will have a switcher that classify the market condition, and then we switch the bot. That is the way to make a profit. And the back test, most common fail is that they don't do the stress test. They don't try in the crisis, right? They need to verify your execution in the crisis too. And the simplest way to do that is you calculate from the maximum loss. So if you do the market making or even like the alpha seeking strategy, you check first your maximum loss per trade and also max consecutive loss. Say you lost in a row. Like say if you lost like 5, your maximum consequent loss is like 5 times, and your max loss is 10%. I would say that you can assume that your drawdown, maximum drawdown is 50%. You can assume that, and you stress test it too. But the major problem is we don't have the data, right? We don't have the data. Because if you do the back test where the candles, where the price, in reality, there is no liquidity at that time. You can't execute your bot. There is no liquidity. That's why you need bid ask in the past too. And that's why I would say thank you to Assistant Professor Wasin again, right? And the last is this. Even you do the market making, you do the execution part, like any case, you have to check the market structure first, the environment at that time. Say the most broad one would be, is it hawkish or dovish, right? It's all about the monetary policy. things will be different. But in the microstructure, say micro level, it would be on the, that one is the market is boom, is going up, or that one is there's no like no news. Say the day you have the non-farm payroll, that day the market activity would be more than the day without news, right? Okay, and the next, when you do the any model, you need to think about the parameter setup, and this one is the most common, say the most common mistake. People will just do the optimization to search for the better parameter setup. Like this one is like a EMA crossover one. The green here shows the cumulative return if you use this strategy. Say I did with the 50 Thai stocks and plot it here. This one is advanced. Like if you use the EMA crossover strategy with the slow and fast here, this one it should return about 30%. But if you use too low, you result in the loss 20%. So most people will just pick, okay, I use this setup 15 EMA with like 35 EMA crossover and use it for like 1 year. But the problem is things will change over time. So you need to backtest them, right? If you use like the EMA crossover as the market condition filter for your bot, say even though you do the market making bot, and when you market making going to the downtrend, you want to remove your bid part, right? You don't want to suffer loss, you remove your bid. Then you need this. And that's why I said in, say, the top tier, that in this field, they will exploit the alpha seeking strategy into their market making strategy too. You will remove it, but you need to check thoroughly that it is still valid in that environment. And also for those who use the pattern, say, pattern recognition, or for now you can just throw it into the OpenAI and let it analyze, right? But it's still like there's still some mistake that can happen. It's not easy one. This one this site is like 10 years ago already, but it still lasts here. All right, so okay. Next is on the arbitrage one. Say this is more like the banking business, and I say is trader dreams. Everyone would dream of having a free lunch, but I would say that in reality there is really no free lunch. Most of the free lunch are taken by those rich guys who have a bunch of money, rich infrastructure, and like they will own the co-location with the server box, the nearest. You know, they will get the first signal and first transmission order. So let's begin with the basic first. The arbitrage has so many types of arbitrage, but the basic one is a spot arbitrage that between the exchange. And another is the arbitrage between the spot and futures, spot and warrants, spot and options, even spot and derivative warrants. Those are kind of underlying with financial products. Or you can do like arbitrage between like Thai future, oil futures with the global one, but you have to check because Thai oil is based on the Dubai price. But the futures in the world, most people they trade the WTI, which is at Cushing, and also the Brent. Problem is how you define that is it mispriced or not, right? You need to calculate the shipping costs and those stuff too. And frankly speaking, not frankly, I would recommend not to do that because I got my friend who work in this business. They got unlimited credit line, literally unlimited credit line, and that average leverage amount, average say the leverage ratio is around 50x. 50x. So just a very minor move that earns us enormous profits already. So we cannot compete with them in reality. But the spot arbitrage is happens. Say even now it's happen in night market. Say you can have a Google sheet comparing the price, and you can just set alert when the price difference is above your fees, and you wake up at the night and you trade. I did that a lot, like 8 years ago in Thai market. Okay, the next, this one would be, say that this one most common is from Edward Top. Anyone know Edward Top here? Edward Top is the owner of the book Beat the Dealers. Say he's the one who invented the strategy to beat in the casinos. And one day he get kicked out from casino, so he moved to the market, to the stock market. And he realized one thing, that the better the stocks, the price move up, and he lost his profits. Say he's not good in VI. So he turned into more something like mathematics. And he's say it is believed that he is the first one who discovered the Black-Scholes model, the relationship between the stock price and option price, say call and put option. So here is like checking the price, and if you go through all the formula, you will get the correct option price. In reality, they don't use Black-Scholes. That's the first problem. In reality, you have to find first. Some will use the Neumann, some will adapt the Black-Scholes with other things. But you still get some sense when you use the Black-Scholes model. So don't be that worried. But you can set like the threshold to make sure you make profits from that. Say it's very simple. You check the price. If the price is missed, then you come to this. This is reality. The first is that is it really mispriced or your model is missed? So when we're talking about the options in classroom, the option value is time and its intrinsic value. But when in the banks, when I talk with my friends, all we care is how much is the volatility down. Higher volatility is mean expensive. Lower is mean cheap. And some model will sensitive to some price movement, some pattern. It's quite a bit different, but that's more on, say, it would impact like 5%, but that more enough, like, because the hedge fund is monitoring this. In global market, they're monitoring this. So even 5% miss, they will take it. So in reality, when it's mispriced like 0.x something, they have very low fees. They will start their move. Let me point. So what we are talking is about this. But when we're talking about the futures, like the misprice between the spot and futures, which is very famous now in Thailand, known as the cash and carry arbitrage, right? You long spot, you short futures, do that with the digital asset, you earn profits. But if you do it with Thai, say, set 50 futures and set 50, the basic risk is not that easy, because there are hedge fund they are doing their job here. And what I see is there's like some manipulation in the markets, say in not outlaw way. It's like they do things with HFT things. And sometimes even the formula say that the basis would be higher. So normally the basis would be higher in the futures and spot, right? But sometimes when sentiment turn to negative, the basis can flip. I experienced this already. It's flipped from +2 to -2 in just 1 hour, like from in the morning session and afternoon session. It flipped by 4 points. 4 points is more than enough when you do these kind of things. And in Thailand, the major problem that we face is that it's too low liquidity in the option market, right? And the next challenge is sometimes it exists, but you need some OTC dealing. You need to do synthetic. You need to walk to the bank if you have high volume. But if you are retails, do things like say 10,000 baht, 100,000 baht, it's still doable. But if you start to do things like profit per each transaction is like 1 million, it start to getting a lot harder. You need to go to the bank and ask them for the OTC deal. And say most of the time they just say no. Right. That is what's happening in the market. All right. So you get some essence on what's going on in the market, the strategies that people use. And next, I would spend the last 5 minutes, 10 minutes to the futures. What will happen? Say the future is all about the technologies now. Technology plays a very important role in the financial market, right? From aggregate data to send data. And more than that, now this era we are talking about the millisecond transaction. Say things that can do in the past, like this. Let me jump a bit. Like this, if you want to analyze all the 500 stocks in the S&P 500, or even in the SET, right, SET, you need a lot of computing power. But now you can do it with just your laptop, with your Python code, in few seconds. And if your computer is great enough, you can do it in milliseconds. And imagine those who have billions dollars, supercomputer, they do it in milliseconds too. So that is what's happening now. They analyze the whole market all together in milliseconds. And they spot opportunities. And that's where we got problems because since the past, the technology comes first, and then there's some clash, some problem, and regulator follows. Even now, the HFT is used for some. It's believed that it was used to manipulate the price. Imagine you have the bid and offer. If you have enough money, you just press all your bid and offer like 100 millions. So the retailers have to be on the top of your bid, right? And when you want to sell, you just pull off your bid and you sell, and then you put it back. The streaming fetch time cannot see any difference. It's too fast. It's happened too fast, right? So that is the challenge now, and that case was with the China market in 2015. The Citadel do that. So they pump the stock up, and they use money as their bid to make things look like it's still going up. And then they start to sell a bit and a bit and a bit, but remove the bid, sell and put it back again, doing it like this. Until one day Xi Jinping noticed and freeze their account. It's very funny. Okay, all right. And for the Thai, right now I think we need a lot to discuss later on to how to make a policy for the HFT in Thailand, because it just start. I would say that it is just start. Even the speed is not fast enough now. But things will evolve later on. So in the future, what will going on is, say, is happening now. I'm doing this too. We use AI to analyze news, and then we turn it into signals. I get a sense of the broad market for the news, also from the influencer in the social. And then we analyze them all together. Then we use the quant model to analyze, is it a good time to buy or sell? It's happening now. And say, the Twitter trading is happening like 10 years ago, but with the, say, OpenAI and Gemini, things are much easier. The model are much, say, a lot smarter than that time. So the fundamental nowadays can be quantified. It all can be quantified and then put it to the computer and analyze the transaction. And next would be on the alternative data. Say it's happening now also because I used this like 5 years ago when I was doing managed funds. I code, say, if I want to analyze a Salesforce company, I get into that website. I look at the new user. I check the new user every day. So right before, just say end of the quarter, I already know how many users they got, right? And I can predict their earnings. And hedge fund doing this for like several years already, and it will become more traditional things. Like this is those who visit the Apple store in the Fifth Avenue. Imagine you got all this information for the apples, all the branch. You can calculate this, right? And in Thailand, the AIS and True start to sell this kind of data. So the future is simply like all the way toward the AI and data stuff. And I would say that it will no longer just predict, but the AI will also adapt to the real-time situation too. And perhaps it will take what you like or you don't like into their account. Like some people, they don't like to trade gold. Some people, they don't like stocks. It will incorporate those two in the robo-advisor. And the alternative data will be just another data. It will become cheaper and cheaper. Right? 5 years ago, to buy the Chinese data for the mobile app, it cost $30,000 US, 1 million baht. It's very expensive that day. And I believe AI will do something. You know, AI will, without good governance on AI, it will do something to the market, and I think that's the time where regulators have to step in and do something with it. But we don't know it now. It's very hard to know, right? All right, any question? Okay. All right, so thank you very much.
Thank you
And
very
good-
much for
And good luck
Okay.
on your competition.
Thank you for the impactful information of the landscape of modern trading strategies, which give us the view of the world real applied strategy. Well, that's the wraps up of our research segment. We hope you have enjoyed the information and also the academic perspective shared thus far.
We'll now have a 15-minute coffee break, and refreshments are served just down below at room 224. Please follow our staff directions outside there and return to your seat by 15:15. We will start our panel discussion on time.
All right, but before we go to break, can I